risk appetite rebounded strongly in October. As a result, equity markets and commodity markets rebounded. The S&P 500 gauge of US stock markets had one of the strongest monthly gains since the fourth quarter of 2008. Government bonds, on the other hand, particularly in Europe, gave back some of the gains that they had made in the third quarter. Economic data for the US stabilised since the start of October, pointing to a slower economic growth outlook than would have been expected in the first quarter of 2011, but not a recession as some commentators may have feared. Elsewhere in Europe, the policymakers are now committed to dealing with the Eurozone crisis. And this helped markets in October. However, since November, some of this has been put into disrepute. European leaders agreed on a new package for the Eurozone sovereign debt crisis at the end of October. This package was well received by markets. The package included to increase the amount of money available to countries or banks that were finding themselves difficult to fund in the markets. It also asked holders of Greek government bonds to take a 50% haircut on their holding versus the 20% haircut that had previously been agreed. Elsewhere, it also brought up the first signs of a discussion about further economic and fiscal reforms in the Eurozone region. However, this could take a while to fully put through. However, since November, political concerns have increased, particularly in Greece and Italy. In Greece, the government has now formed a unity government which are committed to the Eurozone bailout and the Eurozone region. This may ease some of the concerns there. However, markets are now focusing on Italy, and the 10-year government bond yield in Italy has increased to 6.6%. This is very close to a level that is unsustainable for Italy to finance itself, and as a result may need assistance from the EU and the IMF. The political risks in Europe are very high and are leading to large swings in many asset classes, as we have seen in recent weeks. It is difficult to see this volatility easing. However, European leaders are committed to responding to the crisis, and we believe that they will come up with an adequate response. Secondly, the stabilisation of the economic data, particularly in the US, is very supportive of equity markets at these levels. However, a systematic shock to the Eurozone system would disrail this economic outlook.